you will remember, was it yesterday or the day before, I was sharing with you a Financial Times story. In fact, I just threw it away. Anyhow, the title of it was something like, the bond market is roaring, corporate bonds. And I was talking about how all these, this scam that's going on in corporate America right now, where companies are merging together, getting bigger and bigger and bigger. And there's two things going on. One is the mergers. They make money for the banksters, and they make money for the senior executives. But they cause massive layoffs. They destroy the middle class, and they destroy competition, which was the whole idea of the Sherman Antitrust Act: maintain companies at a size where they can compete with each other. But A, these mergers have been happening, and B, a lot of these companies have simply been buying back their own stock. And they're borrowing money to do it. Now, why would they borrow money to buy back their own stock? In order to raise the price of the individual shares. Now, why do they care about the price of the individual shares? Because all their senior executives are being compensated with stock options. They don't give a rat's ass about what it does to the community, to the workers, to the customers, to the institution of the corporation itself. They don't care about any of that. They only care about, the price of the stock. And today's, this was over at Bloomberg, today's Bloomberg, and a tip of the hat to Shano, who pointed this out to me. It looks like the banks are looking at this going, this gravy train is not going to continue forever, and we don't want to be, when the music stops, we don't want to be the one that doesn't have a chair. The article was written by Shrindar Natarajan and Christine Idzels. It's over at today's Bloomberg.com website. Investors who piled into anything and everything in the junk debt market in recent years have begun to run in the other direction at the first sign of trouble. The turnaround has caught Wall Street's biggest banks off guard and is increasingly leaving them on the hook for funding takeovers that investors want little part of. On Tuesday, the investors would be people putting up the money, right? The people loaning the money. On Tuesday, Bank of America Corp and Morgan Stanley were forced to shelve the debt package backing the year's largest leveraged buyout, $5.5 billion, to fund Carlyle Group's purchase of Veritas, which is Symantec Corp's data storage business. Fixed income investors are fast pulling down the shutters on the riskiest deals. That has left banks grappling with more than $15 billion of deals the money managers have rejected or demanded huge discounts to buy in recent weeks. I'm telling you, when the insiders start talking to the insiders like this, what they're saying is, Doc, put your money in cash, put your money in bonds, but Doc, excuse me. Very interesting times. By the way, some of the banking rules are going to change at the first of the year. The capital requirements. It's going to be real interesting to see what happens right after the first year. To watch more clips from our programs, hit the Watch More Videos button over here. And please be sure to hit the handy-dandy subscribe button so you'll always be up to date. Tag, you're it.